The relationship between the United States and China has been strained for years. Trade disputes, technological competition, and geopolitical rivalry have created a rift between the two global powers. The ongoing trade war, initiated in 2018, has further exacerbated these tensions. The imposition of tariffs on each other's goods has disrupted global supply chains and increased costs for businesses and consumers alike. China's recent move to sell off its holdings of US Treasury bonds marks a significant escalation in this economic conflict, carrying potentially far-reaching consequences for both nations and the global economy. The trade war began with the Trump administration's decision to impose tariffs on billions of dollars worth of Chinese imports. The stated goal was to protect American jobs and intellectual property. China retaliated with its own tariffs on US goods. This tit-for-tat exchange of tariffs has continued under the current administration, albeit with some modifications. The result has been a decline in bilateral trade and increased uncertainty for businesses operating in both countries. US Treasury bonds are essentially loans issued by the US government to finance its operations. These bonds are considered among the safest investments in the world due to the full faith and credit backing of the United States government. When an investor buys a Treasury bond, they are lending money to the US government for a fixed period. In return, the investor receives periodic interest payments known as coupon payments, and the principal amount of the bond is repaid upon maturity. The interest rates on Treasury bonds fluctuate based on market forces, such as inflation and economic growth. They serve as a benchmark for other interest rates in the economy, including mortgage rates, corporate bond yields, and even the interest rates on savings accounts. China, once the largest foreign holder of US Treasury bonds, has been steadily reducing its holdings in recent years. This strategic move is widely seen as a response to the ongoing trade tensions and a means of applying pressure on the United States. By selling off its Treasury bond holdings, China is essentially calling in its loans to the US government. This influx of bond sales into the market increases the supply of bonds, which, in turn, can lead to a decrease in their price. The implications of this sell-off are significant. As bond prices decrease, their yields, which move inversely to prices, increase. Higher Treasury yields have a ripple effect throughout the US economy, influencing interest rates on everything from mortgages to corporate loans. This can impact consumer spending, business investment, and overall economic growth. Section 4. The Ripple Effect. How rising interest rates impact you. The impact of rising interest rates on the average American is multifaceted. For those looking to buy a home, higher interest rates translate into higher mortgage rates, making homeownership more expensive. This can dampen demand in the housing market, potentially leading to a slowdown in construction and related industries. Higher interest rates also affect the cost of borrowing for businesses. Increased borrowing costs can discourage investment in new projects, expansion plans, and hiring, potentially slowing economic growth. Consumers also feel the pinch as interest rates on credit cards, auto loans, and student loans rise, making it more expensive to finance purchases and manage debt. Section 5. A global financial chess match. Decoding China's strategy. China's decision to sell off US Treasury bonds is a calculated move in the ongoing economic and geopolitical chess match between the two nations. By reducing its exposure to US debt, China is aiming to diversify its foreign exchange reserves and reduce its vulnerability to potential US economic pressure. However, this strategy is not without risks for China. Selling off large amounts of US Treasury bonds could trigger a decline in their value, potentially undermining the value of China's remaining holdings. Moreover, a rapid sell-off could disrupt financial markets and harm the global economy, which would ultimately hurt China's own economic interests. Section 6. The Road Ahead. Potential implications of China's financial tactic. The future implications of China's decision to sell off US Treasury bonds remain uncertain. The move could escalate economic tensions between the two countries, leading to further retaliatory measures and a deepening of the trade war. Alternatively, it could serve as a wake-up call, prompting both sides to engage in more constructive dialogue and seek a resolution to their differences. Regardless of the outcome, China's actions serve as a stark reminder of the interconnectedness of the global economy and the potential consequences of economic conflict between major powers. It also highlights the importance for individuals, businesses, and policymakers to closely monitor developments in the US. What could happen next? Let's break it down. First up, interest rates. If China keeps selling US bonds, expect interest rates to keep climbing. That means borrowing will get more expensive for everyone, from the government to regular families. Imagine trying to get a mortgage or a car loan, only to find it costs a lot more than it used to. So, who steps in? The Federal Reserve or the Fed might intervene. The Fed controls interest rates and the money supply. If rates go up too fast, they might start buying bonds themselves to bring rates down. This is called quantitative easing. They did it during the 2008 crisis and again during COVID-19. Now, about the stock market. Rising interest rates often scare investors. If borrowing costs go up, companies might make less money. That can lead to lower stock prices and more market instability. It's a bit like a roller coaster ride, but not the fun kind. The biggest long-term risk is financial decoupling. This means the US and China stop trusting each other's money and financial systems. China might stop using the US dollar in trade. The US might block Chinese investments. Both countries could build separate financial systems, splitting the global economy. That could mean more instability, less cooperation, and higher costs around the world. So, what can regular folks like you and me do? The financial world can feel far away from daily life, but these issues affect real people in real ways. Andre Geek, a popular finance YouTuber, has some solid advice. First, stay invested in the stock market. Even though the market is shaky, Andre continues to invest. He focuses on broad index funds like VTI, which tracks the entire US stock market. These kinds of investments are less risky than trying to pick individual stocks. Next, consider buying Bitcoin on dips. Andre also invests in Bitcoin, especially when prices drop. He believes Bitcoin is a long-term way to protect money from inflation and government instability. He moves his Bitcoin into secure storage called cold wallets, so it can't be hacked. Lastly, don't try to time the market. Trying to guess when to buy or sell can backfire. Instead, Andre says it's better to stay informed, invest regularly, and think long-term. In conclusion, the US-China relationship is entering a dangerous phase. What started as a trade fight is now turning into a financial war. By selling US Treasury bonds, China is using one of its most powerful tools to hit back at the United States. But this move doesn't just affect Washington or Beijing, it affects everyone. Homebuyers, business owners, students, and retirees. The bond market may not be as flashy as the stock market, but it's where the real battle is happening right now. Interest rates are rising, uncertainty is growing, and the decisions made by governments on opposite sides of the world are already impacting American wallets. As individuals, we can't control what China or the Federal Reserve does, but we can stay informed, stay prepared, and make smart choices with our money. Whether it's investing in the market, saving more, or diversifying with assets like Bitcoin, the key is to stay calm and focused, even when the headlines get scary. The world is changing fast, but knowledge is power. And the more you understand what's going on, the better you can navigate whatever comes next. Thanks for watching, and don't forget to like and subscribe for more insights. See you next time.